Welcome to the Merging Life and Money Show. In today's episode, MarieJo Caesar is diving deep into financial strategies that every Black entrepreneur needs to know. Whether you're struggling with cash flow management or looking to diversify your funding sources, this episode is packed with actionable insights to help you build a financially resilient business. And don't forget, MarieJo is also offering a complimentary download of the Black Entrepreneur's Holistic Financial Wellness Plan template to help you create a holistic financial wellness plan. Stay tuned. You won't want to miss this.
Hello and welcome to the second episode of our National Black Business Month series. In the world of business, money is more than just green. It is a lifeblood that keeps your dreams alive. If you tuned in last week, you know we explored the resilience of Black-owned businesses and how overcoming challenges can pave the way for success. This week, I am excited to take you deeper into a topic that is critical for transforming your business from merely surviving to truly thriving. And this is financial strategies for Black business owners. Today, I will address the financial strategies that every Black entrepreneur needs to master. From optimizing cash flow management to diversifying funding sources, and from strategic financial planning to risk management, I will guide you through the essential steps that can help you build a solid financial foundation for your business. These are not just tips, they are powerful tools designed to empower you to make informed financial decisions that drive long-term success. For those of you who do not know me, I am MarieJo Caesar, your holistic financial wellness strategist. My mission is to help you take control of your finances from the inside out, ensuring that you are equipped to navigate the complex financial landscape that business ownership demands. Before we get started, I am letting you know that this episode will be a bit longer than usual. It's all about giving you the confidence and clarity you need to take your business to new heights. So grab your notepad and get comfortable because we are about to begin a journey that could redefine your financial future. Welcome to the Merging Life and Money Show. Before we start our discussion about financial strategies, it is important to remember that the foundation of any thriving business is its financial health. You cannot hope to scale, innovate, or even sustain your business if your finances are in disarray. Think of your business finances as a root of a tree. Without strong roots, the tree cannot stand tall, let alone bear fruit. With that in mind, let's talk about one of the most critical aspects of financial health: mastering cash flow management, the first part of today's episode. Last week, I discussed the resilience required for Black-owned businesses to overcome systemic challenges. We looked at how figures like Janice Bryant Howard use not just determination, but strategic financial management to grow successful enterprises. Today, I want to build on that by exploring how you can apply similar financial strategies to ensure your business not only survives, but thrives. When it comes to running a successful business, cash flow management is the heartbeat that keeps everything moving. It is a process of tracking how much money is coming in and going out of your business, ensuring that you have enough cash on hand to cover expenses, invest in growth, and weather any financial storms that may come your way. Unfortunately, poor cash flow management is one of the leading causes of business failure. According to a study by CB Insight, 38% of startups fail because they run out of cash or fail to raise new capital. For Black-owned businesses, which often face additional challenges such as limited access to capital, Mastering cash flow management is not just important, it is essential. To get a handle on cash flow management, you first need to understand the cash conversion cycle. It is a metric that helps you understand how long it takes for your business to convert its investments in inventory and other resources into cash. In simpler terms, it is the time it takes for $1 spent on inventory to turn back into $1 of revenue. The cash conversion cycle has three main components. Days inventory outstanding, or DIO. This actually measures how long it takes for your inventory to turn into sales. 2, days sales outstanding, or DSO. This measures how long it takes to collect payment after a sale has been made. And 3 is days payables outstanding, or DPO. This measures how long you take to pay your suppliers. By understanding and optimizing your cash conversion cycle, you can improve your cash flow and ensure that your business has the liquidity it needs to operate smoothly. For Black business owners who may already be working with tighter margins and limited access to credit, optimizing the cash conversion cycle can be a game changer. One of the most effective ways to improve your cash flow is by streamlining your invoicing and collection processes. According to QuickBooks, 64% of small businesses have invoices that go unpaid for at least 60 days. This can create significant cash flow problems, especially for Black-owned businesses that may not have the financial cushion to absorb late payments. Here are some strategies to improve your invoicing and collections. Set clear payment terms. Be explicit about your payment terms upfront and make sure they are clearly stated on every invoice. Send invoices promptly. The sooner you send out your invoices, the sooner you can expect to get paid. Offer incentives for early payment. Encourage your client to pay early by offering a small discount for payments made within a certain time frame. Implement late fee fees. On the flip side, consider implementing late fees for overdue payments. Use invoicing software. Invest in invoicing software that automates the process and sends reminders to clients who have not paid on time. Tools like QuickBooks, FreshBooks, and Xero can help you stay on top of your invoicing and reduce the chances of missed payments. For Black business owners who often have to be more strategic with their resources, these invoicing and collection strategies can make a significant difference in maintaining healthy cash flow. In today's digital age, there is no reason to manage your cash flow manually. There are numerous tools available that can help you track your cash flow in real time, giving you a clear picture of your financial health at any given moment. Here are some benefits of using cash flow management software. Real-time data. Cash flow management software provides real-time data on your income and expenses, allowing you to make informed decisions quickly. Forecasting. Many tools offer cash flow forecasting features that help you predict future cash flow based on historical data. This can help you anticipate potential cash shortfalls and take proactive measures to address them. Automation. Automating your cash flow management can save you time and reduce the risk of human error. For example, you can set up automatic bill payments, recurring invoices, and payments reminders. Integration. Most cash flow management tools integrate with other financial software, such as accounting and payroll systems, providing a seamless flow of information across your business. Some popular cash flow management tools include Float, a tool that integrates with accounting software like Xero, and QuickBooks to provide real-time cash flow forecasting and management. Pulse, a cash flow management tool that helps you monitor your cash flow, create scenarios, and plan for the future. Plan Guru, a comprehensive budgeting, forecasting, and financial planning tool that can help you manage your cash flow more effectively. For Black entrepreneurs who may already be stretched thin managing multiple aspects of their business, utilizing technology for cash flow management can be a game changer. It allows you to stay on top of your finances without spending hours crunching numbers and giving you more time to focus on growing your business. Another effective way to improve your cash flow is by negotiating favorable payment terms with your suppliers. This can give you more flexibility in managing your cash flow and ensure that you have enough cash on hand to cover other expenses. Here are some strategies for negotiating better payment terms. Build strong relationships. The stronger your relationship with your suppliers, the more likely they are to offer you favorable payment terms. Take the time to build rapport and demonstrate that you are a reliable customer. Ask for extending payment terms. If you are struggling with cash flow, don't be afraid to ask your suppliers for extended payment terms. Just make sure you do not overextend yourself and jeopardize your relationship with a supplier. Negotiate discounts. Some suppliers may be willing to offer discounts for early payment. If you have the cash available, this can be a win-win situation, allowing you to save money while improving your cash flow. Consider barter arrangements. In some cases, you may be able to negotiate a barter arrangement with your suppliers where you exchange goods or services instead of cash. This can be a creative way to improve cash flow without spending money. For Black business owners who may face additional challenges in accessing capital, negotiating favorable payment terms with suppliers can provide much needed breathing room in managing cash flow. I will end this first point and state that mastering cash flow management is not just about keeping the lights on. It's about positioning your business for growth and success. For Black business owners who often face additional challenges in accessing capital and managing thin margins, true cash flow management is critical. Remember, cash flow management is not a one-time task. It is an ongoing process that requires attention and diligence. But by taking the time to master this critical aspect of your business, you will be well on your way to building a successful and sustainable enterprise. I therefore challenge you to implement at least one of the strategies we just discussed, whether it's optimizing your cash conversion cycle, improving your invoicing process, or negotiating better payment terms with your suppliers. Take that first step to achieve stronger financial management. This takes us to the second point of today's episode: how to diversify your funding sources. Another important strategy for Black-owned businesses looking to build a long-term financial resilience. While having a firm grasp on your cash flow is an essential step in ensuring your business stays financially healthy, it is just one piece of the puzzle. To truly protect your business against financial challenges and position it for growth, you need to think bigger. That means exploring all the avenues available to secure funding and strengthen your financial foundation. When it comes to building a resilient business, relying on a single source of funding can be risky. Diversifying your funding sources is like creating multiple streams of income. It spreads out your risks and gives your business a better chance to survive and thrive in a competitive market. For Black business owners who often face additional challenges in securing traditional financing, exploring alternative funding options and maximizing opportunities become even more critical. One of the first steps in diversifying your funding source is looking beyond traditional bank loans. While bank loans are a common source of capital for many businesses, Black entrepreneurs often encounter barriers that make it more challenging to secure these funds. According to the Federal Reserve, only 69% of Black-owned businesses that applied for traditional financing receive at least some funding, compared to 83% of white-owned firms. This disparity highlights a need to explore alternative lending options that can provide the capital necessary for growth. Here are six examples. I will start with CDFIs, the acronym for Community Development Financial Institutions. As noted in previous episodes, CDFIs are specialized financial institutions that provide loans and financial services to underserved communities, including Black-owned businesses. These institutions often have more flexible lending criteria than traditional banks and are focused on supporting businesses that may struggle to secure financing elsewhere. By working with a CDFI, you can access capital that might otherwise be out of reach while also benefiting from the financial education and resources this institution often provide. Crowdfunding is another one. It has emerged as a powerful tool for raising capital, especially for small businesses and startup. Platforms like Kickstarter, GoFundMe, and Indiegogo allow you to raise funds from a large number of people, each contributing small amounts. This method not only helps you secure funding, but also builds a community around your business. Successful crowdfunding campaigns can serve as proof of concept, demonstrating market interest in your product or service and making it easier to attract additional funding down the line. The next one is online lending platforms. In recent years, online lending platforms have gained popularity as an alternative to traditional bank loans. These platforms, such as Kiva, that spells Kiva, Lending Club, and Funding Circle, connect businesses with individual investors who provide funding in exchange for interest payment. Online lending platforms often have more relaxed lending criteria, making them accessible to businesses that might not qualify for traditional bank loans. However, it is important to carefully evaluate the terms and interest rates as they can vary significantly. Another valuable resource for Black business owners is supplier diversity programs. Many large corporations and government agencies have established these programs to increase their procurement from businesses owned by minorities, women, and veterans. By becoming a certified diverse supplier, your business can access new opportunities, secure contracts, and build relationships with major organizations that might otherwise be difficult to reach. To participate in a supplier diversity program, your business typically needs to be certified as a minority-owned business. Certification can be obtained through organizations like the National Minority Supplier Development Council, or MSDC, or the Small Business Administration. Once certified, your business will be listed in directories that corporations and government agencies use to identify potential suppliers. Certification not only opens doors to new contracts, but also enhances your business's credibility and visibility. Networking is very significant when it comes to funding sources. It plays a major role in maximizing the benefits of supplier diversity programs. Make sure to attend supplier diversity events, trade shows, and matchmaking sessions to connect with procurement officers and decision makers from large corporations. Building relationship with these individuals can lead to contract opportunities and long-term partnerships. Additionally, networking with other diverse suppliers can create opportunities for collaboration and resource sharing. Let's look at a case study. Consider the story of a Black-owned construction company that leveraged supplier diversity programs to secure contracts with major corporations. By becoming certified through the NMSDC and actively participating in networking events, the company was able to establish relationships with procurement officers at several Fortune 500 companies. These relationships led to multiple contracts, which significantly contributed to the company's growth and stability. I will add that while loans and crowdfunding are viable options for securing capital, equity financing from angel investors and venture capitalists can provide a significant boost to your business. However, attracting investment from these sources requires a compelling business plan, a scalable model, and a strong pitch. What are angel investors, you might ask? They are individuals who provide capital to startups and small businesses in exchange for equity ownership or convertible debt. Unlike traditional lenders, angel investors are often more willing to take risks on early-stage companies with high growth potential. For Black entrepreneurs, building relationships with angel investors can be an effective way to secure funding while also gaining valuable mentorship and industry connections. To attract angel investors, it is essential to clearly articulate your business's value proposition, market potential, and growth strategy. Prepare a detailed business plan and a compelling pitch that highlights the problem your business solves, your unique solution, and the potential return on investment. I will note that networking is key to connecting with angel investors. Consider joining an organization like the Angel Capital Association or attending pitch events and startup competitions. On the other hand, venture capitalists are firms or individuals that invest in early-stage companies with high growth potential in exchange for equity. While venture capitalists typically invest larger amount of capital than angel investors, they also expect a higher return on investment. Securing venture capital can provide your business with the resources needed to scale rapidly, but it also requires giving up a significant portion of ownership and control. For Black entrepreneurs who have historically been underrepresented in venture capital, securing VC funding can be particularly challenging. According to a study by Crunchbase, Black-funded startups receive only 1.2% of the $147 billion in venture capital invested in the first half of 2021. To overcome these barriers, it is essential to build a strong network with the venture capital community. Seek out funds that focus on diversity and develop a business model that demonstrates significant growth potential. Now, let's talk about emerging funds focused on diversity. In recent years, there has been a growing recognition of the need to increase diversity in venture capital. As a result, several funds have been established to invest specifically in businesses owned by minorities and women. For example, the New Voice Fund, funded by Richelieu Denise, which I mentioned in the previous episode, is a $100 million fund that invests in businesses owned by women of color. Similarly, SoftBank's Opportunity Fund has committed $100 million to invest in startups led by funders of color. These funds not only provide capital, but also offer mentorship, networking opportunities, and access to a broader ecosystem of resources. A few moments ago, I mentioned pitching to venture capitalists. How should you go about it? When pitching to venture capitalists, it is important to focus on the scalability of your business model. Venture capitalists are looking for companies that can grow rapidly and generate substantial returns. Your pitch should clearly outline your market opportunity, competitive advantage, revenue model, and growth strategy. Be prepared to answer tough questions about your financials, customer acquisition strategy, and long-term vision.
We're halfway through today's episode, and if you're finding this discussion valuable, there's more where that came from. MarieJo Caesar has put together a comprehensive resource, the Black Entrepreneur's Holistic Financial Wellness Plan template, and it's available for free. This toolkit includes a template for creating a holistic financial wellness plan designed to help you align your personal and business finances. Just click the link in the show notes to download your copy. Now, let's get back to those financial strategies that could change the game for your business.
Grants are another valuable funding source that can help Black-owned businesses secure capital without taking a debt or giving up equity. While grants are highly competitive, they offer the advantage of being non-repayable, making them an attractive option for businesses in need of funding. The federal government, as well as state and local governments, offer a variety of grants aimed at supporting small businesses, particularly those owned by minorities. The SBA, for example, administers the Community Advantage Program, which provides grants and technical assistance to small businesses in underserved markets. Additionally, the Minority Business Development Agency, or MBDA, offers grants specifically for minority-owned businesses, helping them access capital, secure contracts, and expand their operations. In addition to government grants, there are numerous private foundations and nonprofit organizations that offer grants to Black-owned businesses. For example, the FedEx Small Business Grant Contest provides funding to small businesses with a focus on diversity and innovation. Another example is the National Association for the Self-Employed, which offers growth grants to help small businesses cover essential expenses like marketing, equipment, and employee training. Here are some grant writing tips. Securing a grant requires a well-crafted application that clearly communicates the value of your business and how the grant funds will be used. When applying for grants, be sure to research the grant requirements, understand the eligibility criteria, application deadlines, and specific requirements for each grant. Tailor your application to meet the grantor's objectives and priorities. Highlight your impact. Emphasize how your business contributes to the community, creates jobs, or addresses a specific need. Grantors are often looking for businesses that have a positive social or economic impact. Provide detailed financials. Include a clear budget that outlines how the grant funds will be used and how they will contribute to the growth and sustainability of your business. Tell your story. Personalize your application by sharing your entrepreneurial journey, the challenges you've overcome, and your vision for the future. A compelling narrative can set your application apart from the competition. Here's a case study. Let's consider the example of a Black-owned technology startup that successfully secured a government grant to develop its product. The startup applied for a Small Business Innovation Research Grant, which is designed to support innovative research and development. By clearly outlining the technical feasibility of their product, the potential market, and the societal impact, the startup was awarded the grant, which provided the funding needed to bring their product to market and attract additional investment. I will end this point by reaffirming the importance of a diverse funding strategy. Diversifying your funding sources is not just a strategy, it is a necessity for building a resilient and successful business. By exploring alternative lending options, leveraging supplier diversity programs, building relationships with angel investors and venture capitalists, and maximizing grant opportunities, you can create a sound financial foundation that supports long-term growth and stability. For Black business owners who often face unique challenges in securing capital, these strategies can make the difference in achieving success. Remember, the key is not to rely on just one source of funding, but to build a diverse portfolio of financial resources that can sustain your business through both good times and bad. As you reflect on your current funding strategy, I encourage you to explore at least one new funding source this week. Whether it's applying for a grant, reaching out to a CDFI, or networking with potential investors, taking proactive steps to diversify your funding can help you unlock new opportunities for growth and resilience. Now, let's discuss the importance of strategic financial planning and risk management, two essential components of any successful business strategy. And that is the third and final point of today's episode. With multiple streams of capital at your disposal, you have the flexibility to invest in growth, weather economic downturns, and take advantage of new opportunities. By having access to funding is just the beginning. To truly ensure your business's long-term success, you need to manage your finances strategically and mitigate potential risk. Running a successful business is not just about generating revenue. It's about ensuring that your financial resources are managed effectively and that the potential risks are mitigated before they can impact your bottom line. Strategic financial planning and sound risk management practices are essential components of any well-run business, particularly for Black-owned businesses, which often face unique challenges and disparities in the marketplace. I will explore the key elements such as developing a comprehensive financial forecast and budget, implementing strong accounting and bookkeeping practices, creating a detailed risk management plan, and building strategic partnerships to share resources and mitigate risks. 1, developing a comprehensive financial forecast and budget. A well-crafted financial forecast and budget are the cornerstones of strategic financial planning. These tools help you anticipate future revenues, expenses, and cash flow, allowing you to make informed decisions about where to allocate resources, when to invest in growth, and how to prepare for potential financial challenges. Financial forecasting involves predicting future revenues and expenses based on historical data, industry trends, and anticipated business activities. A financial forecast typically includes projections for sales, operating expenses, capital expenditures, and cash flow. By regularly updating your financial forecast, you can identify potential shortfalls or surpluses in advance and take corrective actions as needed. For Black business owners, financial forecasting is particularly important because it allows you to anticipate the financial impact of external challenges, such as limited access to capital or economic downturns. According to a survey by the National Bureau of Economic Research, 41% of Black-owned businesses had to close temporarily or permanently during the early months of the COVID-19 pandemic, compared to 17% of white-owned businesses. This disparity underscores the importance of proactive financial planning. To create an accurate financial forecast, consider the following steps. Analyze historical data. Review your business's past financial performance to identify trends and patterns that can inform your forecast. Look at factors such as seasonal fluctuation in sales, changes in operating costs, and past investment returns. To consider industry trends. Stay informed about trends and developments in your industry that could impact your business. For example, shifts in consumer behavior, technological advancements, or changes in regulations can all affect your financial outlook. 3. Incorporate business goals. Align your financial forecast with your business goals. For example, if you plan to expand your product line or enter a new market, the associated costs and potential revenue. Financial forecasting is not a one-time exercise. Regularly update your forecast to reflect changes in your business environment, such as new competitors, economic shifts, or unexpected expenses. Now, let's talk about budgeting. A budget is a detailed plan that outlines your expected income and expenses for a specific period, typically a year. It serves as a roadmap for managing your financial resources and helps you stay on track to achieve your business goals. A well-constructed budget allows you to prioritize spending, avoid overspending, and ensure that you have enough cash on hand to cover essential expenses. For Black entrepreneurs, budgeting is a vital tool for financial stability, particularly in light of the disparity in access to capital and other resources. A 2021 report by JP Morgan Chase Institute found that Black-owned businesses have a median cash buffer of just 21 days compared to 31 days for white-owned businesses. This limited cash buffer makes it even more important to manage your budget carefully. When creating a budget, consider the following components. Revenue projections. Estimate your expected income from all sources, including sales, investment, and grants. Be realistic in your projections and account for any potential fluctuations in revenue. Fixed cost. Identify your fixed costs, such as rent, salaries, and utilities, that remain consistent regardless of your business performance. These costs should be prioritized in your budget. Variable cost. Include variable costs such as inventory, marketing, and production expenses that fluctuate based on your business activities. Monitor these costs closely to avoid overspending. Contingency funds. Allocate a portion of your budget to a contingency fund for unexpected expenses such as equipment repairs, legal fees, or emergency inventory purchases. These funds provide a financial cushion in case of unforeseen challenges. By combining financial forecasting with a well-structured budget, you can gain greater control over your business's finances, make more informed decisions, and better prepare for the future. 2, implementing sound accounting and bookkeeping practices. Accurate accounting and bookkeeping are essential for maintaining the financial health of your business. These practices ensure that your financial records are up to date, accurate, and compliant with legal requirements. They also provide valuable insights in your business's performance helping you make informed decisions and identify areas for improvement. Let's look at accounting versus bookkeeping. While accounting and bookkeeping are closely related, they serve different functions. Bookkeeping involves the day-to-day recording of financial transactions such as sales, purchases, and payments. Accounting, on the other hand, involves the analysis, the interpretation, and the reporting of financial data based on the records maintained by bookkeepers. For Black business owners, implementing strong accounting and bookkeeping practices is key for several reasons. Financial transparency. Accurate financial records provide a clear picture of your business's financial health, making it easier to track cash flow, monitor profitability, and identify potential issues. Tax compliance. Proper accounting and bookkeeping ensure that your business complies with tax laws and regulations. This is particularly important given that the IRS frequently audits small businesses, including those owned by minorities. Access to capital. Lenders and investors often require detailed financial statements when considering loan applications or investment opportunities. Accurate accounting records can enhance your credibility and increase your chances of securing funding. To implement robust accounting and bookkeeping practices, consider the following steps. Choose the right software. Invest in accounting software that meets your business needs. Tools like QuickBooks, Xero, and FreshBooks offer features such as invoicing, expense tracking, and financial reporting. These platforms can streamline your accounting processes and reduce the risk of errors. Hire a professional. If your business's finances are complex, consider hiring a professional accountant or bookkeeper. A qualified accountant can help you navigate tax laws, optimize your financial strategy, and provide valuable advice on financial management. Reconcile accounts regularly. Regularly reconcile your bank account, credit card statement, and other financial records to ensure accuracy. Reconciliation helps you identify discrepancies, prevent fraud, and maintain accurate financial statements. Maintain detailed records. Keep detailed records of all financial transactions, including receipts, invoices, and contracts. These records are essential for tax reporting, audits, and financial analysis. By implementing strong accounting and bookkeeping practices, you can maintain financial transparency, ensure compliance with legal requirements, and gain valuable insights into your business performance. 3, create a risk management plan. Risk is an inherent part of running a business, but with a proactive approach to risk management, you can mitigate potential threats and protect your business's financial stability. A comprehensive risk management plan identifies potential risks, assesses their impact, and outlines strategies to mitigate or manage them. For Black business owners, risk management is particularly important due to the additional challenges and disparities often faced in the marketplace. A well-structured risk management plan can help you navigate these challenges and safeguard your business against unforeseen events. The first step in risk management is identifying the potential risks that could impact your business. These risks can be categorized into several types. Financial risks, for example. These include risk related to cash flow shortages, credit risks, and fluctuations in revenue. Financial risk can arise from factors such as economic downturns, changes in consumer behavior, or difficulties in securing capital. Operational risks. These involve risk related to businesses' day-to-day operations, such as supply chain disruptions, equipment failures, or employee turnover. Operational risk can affect your ability to deliver products or services efficiently. Legal and compliance risks. This includes risks related to legal disputes, regulatory changes, or non-compliance with laws and regulations. Legal risk can result in fines, penalties, or damage to your business's reputation. Reputational risks. These involve risks to your business reputation, such as negative publicity, customer complaints, or social media backlash. Reputational risks can impact customer trust and loyalty. Once you've identified potential risks, assess their potential impact on your business. Consider factors such as the likelihood of a risk occurring, the potential financial impact, and the ability of your business to recover from the risk. Use a risk assessment matrix to categorize risks based on their severity and likelihood, which can help you prioritize your risk management effort. After assessing the risks, develop strategies to mitigate or manage them. These strategies may include insurance, purchase insurance policies to protect your business against specific risks such as property damage, liability claims, or business interruption. Insurance provides a financial safety net in case of unexpected events. Diversification. Diversify your revenue streams, supplier base, and customer base to reduce reliance on a single source. Diversification can help you manage financial risks and reduce the impact of disruption in your operations. Contingency planning. Develop contingency plans for high-impact risk. For example, create a backup plan for supply chain disruptions or identify alternative funding sources in case of a cash flow shortage. Contingency planning ensures that you are prepared to respond quickly to unexpected events. Regular monitoring. Continuously monitor your business environment for new risks and changes in existing risks. Regularly review and update your risk management plan to ensure it remains relevant and effective. By proactively managing risks, you can protect your business, financial stability, minimize disruption, and build resilience against unforeseen challenges. 4, building strategic partnership to share resources and mitigate risks. Strategic partnerships can play a vital role in mitigating risk and enhancing your business financial resilience. By collaborating with other businesses, organizations, or industry experts, you can share resources, access new markets, and strengthen your business competitive position. What are the benefits of strategic partnerships? Resource sharing. Partners can share resources such as technology, expertise, distribution channels, reducing costs and increasing efficiency. For example, a Black-owned bakery might partner with a catering company to share kitchen space and equipment, lowering overhead costs for both businesses. Market access. Partnerships can provide access to new markets or customer segments that may be difficult to reach independently. For instance, a Black-owned fashion brand could partner with a retail chain to expand its distribution and reach a wider audience. Risk mitigation. Collaborating with partners can help spread the risk of new ventures and projects. For example, 2 businesses might jointly develop a new product, sharing the costs and risk associated with research, development, and marketing. Innovation and growth. Partnership can drive innovation by combining the strengths and expertise of both partners. This collaboration can lead to the development of new products, services, or business models that fuel growth and competitiveness. So, how to identify potential partners? When seeking strategic partnership, look for businesses or organizations that complement your strengths and align with your values. Consider the following criteria when evaluating potential partners. Complementary expertise. Seek partners with expertise or resources that complement your own. For example, if your business excels in product development but lacks marketing capabilities, shared vision and values. Choose partners who share your vision and values, as this alignment is critical for a successful partnership. For example, a Black-owned business focused on sustainability might partner with an environmentally conscious company to develop eco-friendly products. Track record. Evaluate the track record of your potential partners, including their reputation, financial stability, and past collaborations. A partner with a strong track record is more likely to contribute positively to the partnership. And here is a practical application of what we addressed in this point. Let me give you a case study. Consider the example of a Black-owned technology startup that partnered with a larger tech company to develop a new software product. The startup brought innovative ideas and technical expertise to the table, while the larger company provided funding, marketing support, and access to extensive customer base. This strategic partnership enabled the startup to scale quickly, reach new markets, and mitigate the risks associated with product development. Once you've identified potential partners, focus on building strong relationships and managing the partnership effectively. And here is how. Clear communication. Establish clear communication channels and set expectation from the outset. Regular communication helps prevent misunderstandings and ensures that both partners are aligned on goals and responsibilities. Mutual benefits. Ensure that the partnership is mutually beneficial, with both partners contributing and receiving value. A partnership that benefits both parties is more likely to be sustainable and successful in the long term. Formal agreements. Document the terms of the partnership in a formal agreement, including roles, responsibilities, and the division of resources and profits. A formal agreement provides clarity and helps prevent disputes. Continuous evaluation. Regularly evaluate the partnership's performance and make adjustments as needed. Continuously assess whether the partnership is meeting its goals and delivering the expected benefits. By building strategic partnerships, you can share resources, mitigate risk, and strengthen your business financial resilience. Collaboration with the right partners can help you navigate challenges, seize new opportunities, and position your business for long-term success. I will end this point by addressing the power of strategic financial planning and risk management. Strategic financial planning and risk management are not just about managing your finances. They are about ensuring the long-term success and sustainability of your business. For Black business owners who often face additional challenges and disparities, these practices are especially critical. By developing a comprehensive financial forecast and budget, implementing sound accounting and bookkeeping practices, creating a detailed risk management plan, and building strategic relationships, you can protect your business financial health, navigate challenges, and seize new opportunities. As you reflect on your current financial practices, I encourage you to take proactive steps to strengthen your financial planning and risk management strategies. Whether it's refining your budget, enhancing your accounting practices, or seeking out new partnership, these actions will help you build a resilient business that can thrive in any environment. Now it's time to wrap up this important episode. I'm going to leave you with a thought that resonates deeply with the spirit of entrepreneurship. The best way to predict the future is to create it. This powerful quote, often attributed to management consultant Peter Drucker, perfectly encapsulates the essence of strategic financial planning and risk management. By taking control of your finances and proactively managing risks, you are not just reacting to circumstances, you are actively shaping the future of your business. Today, we discussed 3 key strategies that are critical for building financial resilience in your business. Mastering cash flow management, diversifying your funding sources, and implementing strategic financial planning and risk management. Each of these strategies is a tool that, when used effectively, can help you navigate the financial landscape, overcome challenges, and seize opportunities. Remember, these strategies are not just theoretical concepts. They are practical tools designed to help you create a strong financial foundation for your business. And as we saw in previous episodes, Black-owned businesses face significant disparities, such as the fact that 53% of Black-owned firms are at risk of closure due to financial challenges compared to 37% of white-owned firms. This makes it even more critical to implement strong financial practices. Looking ahead, I am excited to announce that our next episode will be focused on digital marketing tips for Black entrepreneurs. In today's digital age, mastering online marketing is essential for reaching new customers and growing your business. Be sure to tune in for valuable insights that will take your digital presence to the next level. Now that you have the strategies and insight needed to take control of your business financial future, it is time to turn knowledge into action. Understanding and planning are just the first steps. What truly matters is how you implement these strategies to drive real change in your business. I challenge you to take the next step in strengthening your financial resilience by putting today's lessons into practice. To support you in this journey, I'm excited to offer you the second component of the Black Entrepreneurs Financial Resilience Toolkit, the template for creating a holistic financial wellness plan. This complementary resource is designed to help you structure your financial planning efforts, integrating both personal and business finances to create a comprehensive approach to financial wellness. By using this template, you will be able to map out your financial goals, track your progress, and ensure that every aspect of your financial life is aligned with your long-term vision. To download your free copy, simply visit MarieJoCaesar.com. It is time to take charge of your financial future. Start today by creating a plan that will not only support your business, but also empower you to achieve your personal financial goals. Remember, the power to shape your financial destiny is in your hands. Take this opportunity to build a stronger, more resilient business that can thrive in any environment. Thank you for joining me today. Your commitment to your financial wellness is what will ultimately drive your success. I am your host, MarieJo Caesar. I will be back again next week. Until then, continue merging life and money. Bye for now.
That wraps up today's episode of the Merging Life and Money Show. If you found value in MarieJo's insights, make sure to download your free copy of the Black Entrepreneur's Holistic Financial Wellness Plan template. It's packed with tools and templates to help you implement the strategies discussed today. And don't forget to tune in next week, where MarieJo will be sharing digital marketing tips for Black entrepreneurs, another crucial topic you won't want to miss. Until next time, keep merging life and money.